Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
On this episode of Passive Real Estate Investing with Mavericks, I sit down with Mark Ritter to uncover better loans with credit unions.
Hey Mavericks, this is Ava Baukamp, and this episode of Passive Real Estate Investing with Mavericks is brought to you by Legacy Impact Investors. We are an industrial investment firm located in cash flow country, the Midwest. We strive to shield off risk and beat inflation, all while producing predictable cash flow. We curate real estate investment opportunities for busy professionals and other real estate investors seeking passive income. To learn more about what we do and connect with me, go to www.legacyimpactinvestors.com.
Welcome to Passive Real Estate Investing with Mavericks, where we provide you actionable steps for you to grow your passive income and become job optional. Today, during this episode, you're going to get to discover better loans with credit unions. Now, for those of you who are new, I'm your host, Neil Timmins. I love passive income from real estate. Now, before I introduce you to today's Maverick, I want to make a request that at any point, if you like what you hear, give us a thumbs up. Be certain to subscribe to the show, never miss a valuable episode. And if you love what you hear, well, please give us a written review. Be certain to look at the description of this episode. We packed it with thousands of dollars in free resources. Now, today, we've got the privilege to learn from somebody who his company is owned by 13 credit unions. He's been in the lending industry for decades. I would describe today's Maverick, someone who's passionate about lending and doing it on the local, on the community level. Today's Maverick, I've got Mark Ritter here with me. Mark, how you doing?
Pretty good, Neil. Thanks for having me on the show.
I'm excited you're here. Say, for the audience's sake, who are you? Where are you from? What do you do?
So I'm Mark Ritter. I am the CEO of MBFS, which stands for Member Business Financial Service, which was quite a mouthful. So that's why I just say MBFS. And I am the CEO of a credit union-owned company. We're owned by 13 credit unions, and all we do is help out credit unions and borrowers nationwide with real estate investing for residential, commercial, the biggest, the smallest, and everything in between.
Well, it's exciting. It's going to be fun to dive into this. I love talking about lending. Let's start here. What's a credit union? And then maybe what's the difference between a credit union and a bank?
Sure. And I've been in this business a long time. And if you ask my kids, they probably still couldn't even give you a good answer. And when you look at them, they look the same. They have auto loans, they have credit cards, they have ATMs, drive-through lanes, advertising their best rates, all those types of things. But really what the difference is when you look under the covers, a credit union is a not-for-profit cooperative. And that really tends to drive who they are and what they do. There's not a shareholders, stockholders that are looking to pump up the stock. It's really a cooperative for the people in the area, run by the people in the area, tends to be local deposits, making much more local and regional loans to kind of, I like to think of it as that, small business Saturday that we all pump up. Credit unions are your local institution that are really run for the people in a community.
So talk to me about you've got multiple credit unions that own what it is that you do. And yep. So it's kind of like it seems to me like it'd be local, but on steroids. That ultimately you've got a much broader area because of how it's owned, and then ultimately who you serve on both sides of that, both the borrower and then the credit union.
Yeah, and if you think about it, your average credit union is about a $250 million institution. Relatively speaking, in the financial services area, that's not that big.
Right.
And it would be very expensive for somebody to set up a shop with all the software and compliance. And then you have to have credit analysts and buy software systems and buy loan documentation systems. It's a huge investment. So credit unions since they're cooperatives, they also cooperate with each other. So they have formed regional companies like us to basically help out and be able to offer these loans to their members and community much cheaper and more effectively than they could themselves. And we also partner and bring together the credit unions for funding so they can lend and act much bigger than they might actually be.
Mm-hmm. All right, so let's talk about that from a lending standpoint. It sounds like to me you run the gamut on everything that's there, but let's talk specifically about just commercial real estate. We'll exclude residential, single-family homes. Just commercial real estate. Talk to me about asset classes in which you guys participate in from a loan standpoint.
Sure. In today's world, that we see a lot of hospitality and hotels. They seem to be booming and very well. The warehouse space is obviously doing great right now. And two areas that tend to get banged around a lot are the office space and retail space. But we actually will lend into those asset classes because while on a macro level, you see issues, and there are issues, and I think on a macro level we're going to see some worse issues.
Sure.
But on that doesn't mean every deal's a bad deal. That doesn't mean in your marketplace for that particular property and the community and the circumstances behind it, it's a bad deal. So that's what I like, in that we can run the gamut by looking at your deal specifically, instead of somebody in a tower in Manhattan making a broad stroke saying, well, we don't lend into this asset class and we're done. So yeah, that's what I see. The one piece area that I see credit unions that aren't great lenders at, just with some limitations. Sometimes if you're really doing a huge development project, it's kind of tough to get that done through the credit union space. But other than that, it really is an open book on what the credit union community will work with.
Industrial, multifamily, self-storage, mobile home parks.
Exactly.
Okay.
Yep. So yeah, we've seen it all. And we really look what makes sense in your region. There's nothing worse than giving you've probably been through this. You give somebody your loan package, and then it goes off to some black box that you now have no idea where it comes back to. So, when we get that self-storage deal or the mobile home deal, it's done by people and the lenders who can understand it.
Talk to me about the types of loans that you're seeing now, what types of deals you're doing, how things are getting priced. My experience in the recent past has been, we take a property to market in the sense of we're going to go talk to multiple banks to see who's active, what's taking place. And on the banking side, there's a whole bunch of people going, we're not even placing money. Or if we are placing money, we want a pound of flesh. And I'm not knocking it. I'm just saying that they are very limited in terms of their deposit base. They only have so much money to lend, and they've got to make sure it's a killer deal, and they're getting paid probably slightly a premium over what would be a normal deal in today's environment. And then I talk to other lenders where it's a whole nother story. Deposits are strong, but what are you seeing in the credit union world relative to deposits and how active they are in the lending environment?
Sure. Much like everybody else, is that we are seeing we are seeing the depository put much more of a strain than it was in the past. Now, does that mean they're not lending at all? No. This year, we're down about 30%, which seems to be following the trends of everybody else. And much of that is interest rate driven.
Sure.
You'll see deals into the sixes now for what I'll call your standard deal. But you don't see anything that begins with a 5 anymore.
Right.
Now in some of the smaller markets, smaller deals, yeah, you could get up into the 7s. But, and that would really be for your 5-year fixed rates. The one nice thing that I love about MBFS and the federal credit unions is the federal credit unions by statute cannot charge a prepayment penalty. So for a commercial real estate investor, 3 years ago when I was doing a deal at 3%, nobody cared that there wasn't a prepayment penalty.
Correct.
That was not what you would call a selling feature in our loan, because nobody figured it was gonna go down. In today's world, to get a deal done, if you're at 7+%, well, in a year and a half, 2 years, fingers crossed, when rates start to go down, you could have the option to refinance that without a prepayment penalty. And so many investors, relatively new investors, the one thing they look at is just what's my interest rate? What's my interest rate? Get the deal. You sit at closing and you sign all the notes.
Mm-hmm.
But now in a higher interest rate environment, understanding what goes on into the back end in terms and conditions are a big deal, because say rates go down to 5%, 4.75 in a couple years, you may be stuck with that. And one of the things that the question that people don't ask is who's actually funding this loan. And if a bank is borrowing its money from Wall Street and they're hedging that bet, they have a note to pay and they're making a spread on the money. But credit unions generally are funding loans with local deposits that can have a much lower expense structure, so that they have more flexibility. Mm-hmm. Whereas, the banks, Wall Street, when they're borrowing their money, that you just can't come in and pay off the loan.
Yeah, you're absolutely right about that. I think you just hit on something, and I want to make this point for the audience, the passive listeners in the audience. Ask Mark to come on, because I think inside of a deal structure today, specifically on a syndication, the debt is a huge deal. Understanding that debt, and I asked Mark to come on so we could understand it at a deeper level, so that you, the passive investor, when you're evaluating general partners and syndications, you can ask those deeper questions relative to the debt to understand that structure and what that looks like. So, Mark, talk to me about fixed rates. What are you seeing? What do you typically end up doing? 5 years pretty typical. Are there longer options that exist out there? What does that look like?
So almost all of our deals have a structure of a 15-year note with amortizations usually in the 20 to 25-year range. Today's world, you really don't see 30-year amortizations too much, unless it's a brand new property with some really outliers with some long-term national tenants. But usually what we'll see is a 15-year note that adjusts every 5 years based on a preset index.
Mm-hmm.
I like to do that because restructuring and repapering notes is a royal pain.
Right.
And I think it's better for borrowers. I think it's better for everybody. When the people who do the 5-year balloons just drive me nuts, because it seems like you spend your whole life just refinancing and dealing with this, because it's not like an auto loan. You got to put some time and energy into it. And that longer term note gives you some flexibility.
I agree with you. And the fact that there is no prepay that's in place, if somehow something changes, it doesn't preclude the borrower without a penalty or with a penalty to go off and make a change, to have that conversation with you to see where things are at whatever the current time happens to be.
And many times you can negotiate that process through.
Sure. Yeah.
Because that's a simple, it's not if I was in the residential mortgage market, I think I'd pull my hair out because there's so many rules and restrictions. But but in this side, people don't understand sometimes that really virtually there are no rules. The rules are what you can negotiate with your lender.
Right.
But the other side of that is the law also does not protect you.
Correct.
Like it does with the residential and some smaller borrowers. So buyer beware.
Yep.
You just don't sit down and sign your documents and not understand what you're getting into.
Yes, it's a big boys game. You better read every last document that gets put in front of you.
Exactly.
Okay, well, that's an interesting structure in terms of how you do that. I'm curious as to how you get paid. Is it typically, I don't need to know the exact numbers, but is it typically an origination fee? Does it look similar to what one would expect from the bank? Is that somehow on the fee side, independent of interest rate? Is that
Sure.
similar?
Yeah, and think of us, we're not. It's the credit union's money that's going out the door.
Right.
We're more the facilitator working on behalf of the credit union. So think of us like a law firm. We basically get fee for service. We get paid from credit unions when we underwrite loans. We get paid when we put together documentation packages. If you work with one of our lenders directly, we get some of that. We work on the origination fee. But if you work with the credit union person, you work with it directly. And we service right now a portfolio of a little under $3 billion in commercial loans. So we have some servicing fee revenue from that piece.
Yep. No, that makes absolute sense. Let's talk to me about where you think the environment is headed. To me, where we have interest rates have moved very hard, very fast. We practically doubled in 12 or 18 months. There's a whole bunch of money coming down the pipeline where they're on 5-year balloons, where that loan is becoming due and payable. And somebody's going to be staring down the barrel of the gun, if you will, going either in some cases, I'm going to have to give a property back, or I'm going to have to write a check to keep my own property. What are you seeing? What's the sentiment that you're seeing in the credit union world?
Sure. Right now, we're seeing demand is strong. Delinquency has not moved yet. We are seeing very little in terms of delinquency, but credit unions are also lending much more. That's not unusual in the credit union space, is they tend to lag banks in delinquency factors.
Why?
Because they're lending much more on a micro level and know the people versus broad brushes. When you lend in the greater Des Moines area, you can know that marketplace versus mega bank that's lending in the Midwest, and they know they're going to have X numbers, and they're into some areas where they don't have that. And also credit unions, for a historical perspective, people tend to align themselves and move their credit unions up on the priority list because they know that they're there for them in the past. And if they're good to them, the credit unions will be there for them in the future.
It sounds to me like when somebody comes to you and they want to utilize you and your service, your team, what you have behind you is a whole host of people that may participate in a loan. One may take the whole thing. You may end up with 10 participants, depending on the size of the loan. Somebody may be on the sidelines because of whatever their particular situation is, but you still have an outlet, another credit union or a set of credit unions who want to participate in that particular loan.
We're a credit union club.
Yeah.
So you're not, it's, when you knock on whatever bank's door, you're going and knocking on that door of that bank. And if they're in the market, great. And if not, you walk to the next door. When you talk to a CUSO like us, you're dealing with the entire network of credit unions. And I'll give you a good example is, as I mentioned, credit unions tend to be regional lenders, but when you band us together, we just had a deal. Somebody in Pittsburgh was buying a property in Florida. As I say, U-Hauls only go one way. They go, north to south,
That's
not
right.
south to north. So we connected them with a credit union or a lender in Florida, and it was just a seamless process. So in different markets, as people move around, we band everybody together.
This question, if I'm a passive investor looking at at a general partner at a particular offering, say somebody like myself has put this thing together, and I'm looking at the details of a loan, what types of things would I want to pay particular interest to in that loan, to ask a couple of additional questions or a handful of questions to understand what type of debt is going on that project?
Sure. As I mentioned, everybody looks at the interest rate. In today's world, I would pay particular attention to covenants and what are the triggers if those covenants are not met. And one of the pieces is loan to value. You know, as you know, appraisal can be a rather subjective term.
Right.
So if if the credit union or a bank has a loan to value covenant in there and they go get a new appraisal that's slapped way down, because they tend to do that when they're worried, that could trigger a default. What are the debt service coverage ratios and how do they measure that? Is it on your property or is it on your entire portfolio? So really on the back end are what are the hooks for a financial institution to get out of your loan? And because those are crucial and those should be disclosed to you not at settlement, but in the front end in that commitment letter of what are the terms that I have to agree to, not at settlement, but for the life of this loan, because those can become nightmares and your friendly lender can leave and management turnovers. And when new people, if they want to get out of a loan, there's all sorts of documents in there and languages and covenants that they can pull a trigger on to make your life miserable. And they tend to do that when things are bad. They don't do it when everything's perfect and you're paying above market rates.
All right, so let's walk down that path. There's a default. The loan to value has changed because a greater environment has changed. So the value of the property has been reduced. The tenancy, let's call it an apartment complex. Everything's great in the sense of tenants are there, occupancy's fine, they're paying, and in turn, the lender's getting paid on time every time, but the value has changed. Walk me through what can a lender do to make it hell for the borrower, and then what can the borrower do, or what are their options at that point in time?
Sure. They actually what I see these are usually labeled in a big category of non-payment defaults, and you really have to understand the position that you're at with the credit union or a bank. And are you a small fish, big pond, big fish, small pond, or you're fairly equal? And I also would the one thing, if you know a property is impaired, if you're having issues with this, the first thing that I would do is talk with them. Don't have your attorneys write letters, just try to talk with them, because at the end of the day, the last thing a lender wants you to do is say, hey, it's your problem now, here you go, thanks, have the keys, it's yours. Because then that they have a bigger problem, because lenders make lousy property managers.
Right.
And they tend to drive properties into the ground and have much bigger losses.
Right.
So really talk through and identify, is this a long-term problem, or is this a long-term problem with this property, or is this just a bump in the road that we lost a tenant and we can replace and get through? If you have a long-term strategic problem with this property, well, you're trying to get out of it too, and talk with somebody on how you can. Whether you're going to put it up for sale, whether they can, take a below market rate to get through this, whether they can offer you some interest only. But if you look, I have yet to see a credit union with somebody who's in good faith trying to work through a loan that they're making payments on, put a hammer down. I've seen it at a bank. But you really have to treat it and be proactive And if somebody is going to be a jerk, then it's okay to say, well, what does this look like if I hand you the keys back? Because you have a bigger problem and we all have a bigger problem. So let's work through this.
Mm-hmm.
Now, in the meantime, it's also appropriate at that time, make a call to maybe one of your other relationships who identifies it as a short-term problem, who will work with you to get through it. But I really think communication is key to all of this in tough times when working with your lender.
Yeah. What are you most excited about this year?
Whew. I'm glad that you asked about what kind of future markets, and I got kind of sidetracked. I really think I am excited for stability in the interest rate environment. And I think one thing that has shown this year, because everybody talks about, interest rates are going because they want to have unemployment. And I think we have shown this year that the U.S. has a much more resilient economy than anybody thought. Because typically, old people at the Fed, they raise rates and they want to increase unemployment and temper it. But I think we have a imbalance of labor in this country we have for the long term, where we need workers.
Yep.
And people, I always say, if people are working and they're living somewhere and they're paying their bills, everything else can really, everything else will be okay. And even with all the interest rates, with all the inflation, generally, you go out to a restaurant, it's pretty full. You go to an event, people are spending entertainment. So I think the resiliency of our economy has shown through this year.
Mm-hmm.
And I think we're going to find out that the Fed has overshot rates where, they can work its way through and then start to soften things a little bit. We're not going back to 25 basis points with a prime rate of 3.25%,
right?
Because that's okay. They kept it down way too long. And that's, a whole nother story on a lot of this inflation is Fed induced. So probably somewhere in the middle to what I would call normal rates of 6%, 5.5%, 6% is what I don't think anybody is too worried about. I think that's what I'm looking for, of just getting back to, to show that, yes, we're fine. But I'm also really looking forward to the stability, where every month we're seeing the liquidity situation at financial institutions improve. We're seeing them being able to manage it a little bit better. And that's one of the key things. We're seeing that normal flow of deposits start to come back.
That would be great. Tremendous. It would add additional stability in the marketplace and allow us to find a new equilibrium relative to some of the lending that's out there.
Yeah, and we all are in the same boat, where if we know the rules and we know what's going on, there's nothing that makes lenders more skittish than thinking they know what's going to go on a year from now. They usually don't, but they like to think. And everybody gets nervous about not what's today, but what's going to be tomorrow.
Right. Let's do this. I'm going to move on to the final segment, what I call the final four. What do you think holds most investors back, either active or passive? I'm going to give that one to you, from reaching their own next level.
Fear of taking an acceptable level of risk. I think people need to have confidence in themselves and be able to take that level of risk and feeling good about it.
What are you passionate about outside of real estate and lending?
Oh, I love the outdoors. I've just moved 3 hours outside of the suburbs, and I spend most of my every waking moment, when I'm not in my home office, outside, fishing, hiking, or enjoying the outside.
Your favorite book?
Freakonomics.
Love that. Favorite way to make an impact in your community?
I love helping and mentoring high school students, because I think they're smart enough to listen and old enough to take advice at times.
Mark, this has been a great conversation. I love talking about lending. We've been operating in such a dynamic environment that appears to change almost weekly. It seems something's changing, and so this is a fun conversation for people. They want to find you, they want to follow you, they want to connect with you. Where can they go? What should they do?
Sure. If you want to talk with us, and if we don't have a credit union in your area, connect with me and we'll match you up. MarkRitter.com, MarkRitter.com. I'm also very active on LinkedIn. Connect with me and reach out, message me, and we'll get right to you. But the easiest way is the website.
Links below in the show notes. Mark, I appreciate your time. Thanks so much for being here.
Thank you, Neil.
To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.